San Francisco.
It looks like a San Francisco event.
Oh, LA.
Okay, yep.
Great. Good morning, everybody. My name is Matt Gill, and I'm the treasurer of the IAFE. And by being here early this morning, you win a special prize, and I applaud you for getting here early because you get to participate in the highlight of our annual calendar, which is the annual members meeting. And so, without further ado, I'm going to hand over to David Jaffe to run through where we're at with the IAFE. And again, the formal program starts at 9 o'clock. So again, thank you all for being here for this extra special prelude to what we're doing for the rest of the day. So David Jaffe, our executive director.
So, thank you to the IFE bylaws. That obviously this happens every year. So this is going to be a review of 2009. Our fiscal year runs January 1st, 2009 to December 31st, 2009. So which was a fun year, as you all know, coming after 2008. We are in the middle of our 2009 audit right now. We have a volunteer audit every year. So these are audited numbers, but not completely audited numbers. Sponsorship on the income side was $123,000. Membership at $67,055. Job board, I put at 0 to point out that we actually used to charge for our job board, but to increase the number of job postings in 2009 to help out our members, we made that a free service, which increased, hopefully some job postings to help out the members. Miscellaneous income of $57.41 is mostly some random contributions and also some royalties income. One or two of our board members have some books which they donate the royalty incomes from. The expenses side, events, $84,752. A lot of that includes our annual gala dinner, which was, that year was at the United Nations, and also sometimes this year will be at the New York Stock Exchange, which we'll get to in a minute. Management staff fees, $125,750. And that also includes rent and health insurance and sort of all the management fees included. Bank fees, $7,000. Professional fees for our accountants mostly, $9,713. Miscellaneous, as I said, just sort of some computer glitch things and stuff like that. FEOI dinner expense, the FEOI dinner expense is actually separated out from the events, $64,560. And our website's at $17,000, which was high this year. We've done a lot of website internal changes at the beginning of last year to streamline the databases and make it easier for members to register, et cetera. That's where we ended the year. Membership was down a little bit last year. 694 total members, 287 practitioners, 358 students, and 49 academics. Most of our students are either PhDs or the Master's in Financial Engineering students and the sprinkling of undergrads, and 49 academics who have the professor rate. Highlights of the year, we're running about 20 events per year, 20 to 25 actually. We have member-only tutorial sessions and roundtables, so we're trying to increase some of the members-only sessions as well, in addition to the open sessions, which are open for most people. The members section has videos of past events, and we now have more automatic registration, so people who are members and come to a lot of our events don't have to fill in their phone number every single time they register for an event. And the How It Became a Quant panels have sort of taken a life of their own over the past couple of years. This was an event geared for students which started, I think, about 10 years ago in New York once a year, and then has sort of spread to many cities: Ann Arbor, London, Boston, Chicago, Toronto, San Francisco, New York. I think Washington, D.C. will be happening in the fall as well. It was published into a book by Wiley, which has now been, I have Chinese, Korean, and I think I have a Japanese version of it as well. So it's gotten spread around the world. Upcoming events, we'll obviously have our fall calendar. We work on our fall calendar in July, so we don't have the fall calendar yet. Our major events coming up we do have secure is the Financial Mathematics Career Fair, which I believe will be in the 9th year. That'll be hosted here in New York at NYU. All the Masters in Financial Engineering students from across the country come together for a one-day meet and greet interviewing session. If any respective companies or companies you know who are looking to hire quants sometime in the next year, definitely let us know. Registration is free for companies. We usually have about 25 companies participate a year. A lot of the major banks, some hedge funds, New York Fed, a few other firms, et cetera. And then the Financial Engineer of the Year dinner, which is our sort of highlight gala, the most fun event of the year in terms of, not much learning, but a lot of drinking and things, is at the New York Stock Exchange. We had that, for those of you who are there, at the New York Stock Exchange this year. We'll be back at the Stock Exchange, cocktails on the floor of the exchange, followed by a reception in the former luncheon room. And that's all I had. Any questions? Is that a hand?
Yes.
Go ahead.
So, expenses were higher than income.
Yes. Basically, our sponsorship, we do our sponsorship drive at the beginning of the year. So we do it in, basically, sponsorship drive was in December of 2008, January of 2009. As you can imagine, unfortunately, sponsorship was a little bit more difficult this year. We have a surplus so that we're able to cushion the fall, so we're fine. This year, I'm anticipating pretty much breaking even as sponsorships are coming back to life a little bit. Memberships are coming back to life. Our membership numbers are already higher this year. We're able to keep expenses in check. So 2009, unfortunately, was not fiscally a fun year for us, or I think for a lot of people. So, Ira? Journal Derivatives is still our official publication. We have a sort of a quarterly welcome letter. There's a membership application in there. It's still being edited by Steve Fluguski, who's on our board of directors. We still get a 50% discount to it. We've worked with Institutional Investor to expand the discounts so you get discounts for some of the other journals. I would say as the IFE audience has gotten larger over the years and the percentage of technical people who want the journal derivatives, I think, has stayed a little bit smaller. The other thing we've noticed is that a lot of the people who really want the journal derivatives are people in the academic world who now can get it online, or their universities have it and things like that. So there's been a little bit less demand for actually having the paper book. Okay. Mac?
I think if there's no more questions, we'll close this part of the session. Thank you for participating. And we will actually start the formal program in about 10 minutes at 9 o'clock. I think, or is it 9:05?
No, 7 minutes at 9 o'clock.
At 9 o'clock exactly. So
Thank you.
more coffee outside, whatever you need.
And Robert, we'll go back to the holding slides.
I
knew we were going to be asked about that. Sorry? I knew we were asked about that.
Yeah, that's good. I mean, that's the point. Okay.
That's fine. Yeah, that's fine. Hey, what's going on? Hey, Benny. How are you? You're missing the annual meeting.
What?
Exciting annual meeting.
Oh, it just happened now?
The highlight of the day.
Oh, I'm Penny Kagan. Hi.
But I guess this is the start for something and operational. But when you get time, a lot of time.
Some changes.
I was making a lot of time on the ORC front. Whose turn is it?
Not mine.
Somebody else.
I think so. I haven't seen her too. Okay.
Charles had the last one.
Yeah.
The last one, I think someone came up with an idea. Came up with an idea for one. And we were starting to talk about it. So you got the emails.
Timing would probably.
Okay.
We'll talk.
We'll walk around with it.
about that water. It's called cocking. Rosalie, we're glad to meet you. Hey, how you doing? Great to see you.
Keep my phone.
I went to India for the first time for a week. I think that's supposed to be me. You're here. The end of January. Our middle son, he's 27. Back after 10 months. And in January, until about October, we said we missed him too much. We had to. Right. No, I don't know. Personal. Out of the back. Such a just so you know, we went on Forest John Ford. Yeah, I mean, we did the, you know. Yeah, I know. Well, he spent 3 months in India, so he really got to it. But no, it was fantastic. You know, first of all, it was so wonderful. This. Have you heard where I was in Udaipur? Yes, hotel. Hey, how you doing, sir? Good to see you. I won't be able to stay for your stuff, unfortunately, but that's life. Hey. About 10 years. Yeah, exactly. I haven't figured that out yet, but you know, see how they stay loose. Silk cars. Enough to be supportive, but you know, board is funny. You have to see this. Oh, it came out of this.
I misheard you say.
Oh.
Whereabouts are you? Where are you exactly? Okay. Okay, so we might go ahead and set schedule. We might go ahead and start up, and then I'll just have you sort of point your hand, sneak in and sort of attend that way. Is that okay? Okay, let me speak to Leslie and see what she thinks. That works. Leo, there. Hello. It just came up on the cell. Okay, sounds good. Okay, so you should be here soon. So you know, we might actually. Okay, so we'll hold off. Thanks a lot. Yeah, we're gonna be behind. He's on the FDR around 30. He just got off the 34th. Just a quick announcement. We're going to be, just because we're waiting for one of our panelists who's still en route, we'll start in about 5 or 6 minutes. Thank you.
From Wall Street to academia, and obviously, given the events of the last 2 years, this is a task that is all that much more important. And hopefully, as you've seen from the agenda today, we're going to cover a lot of the key topics of the day, and hopefully, we all come away moving forward in our understanding of where we're at. In terms of what we do, we through the course of the year, we host a number of events in the Americas and in Europe, and we have aspirations to kick that off in Asia as well. These events are driven by our very active committees, and we have a number of these, including the credit risk, investor risk, liquidity, operational risk, technology, and educational committees. And I encourage you to, if you're interested specifically in any of those, if you're not already involved, to learn more about these committees and get more involved in their annual activities. Today, as you may know, really is the anchor of our annual our calendar of events, and along with our Financial Engineer of the Year award, an event which we host in February, along with a big dinner, gala dinner, and today we're very pleased to welcome the 2009 FEOY winner, Richard Roll, along with several of our senior IFE fellows, including John Hall, Andy Lowe, and Leo Melamed. And so just a couple housekeeping notes. our press policy is that all of our events are strictly off the record. If you're a reporter, you are not allowed to comment on this meeting specifically, but you're welcome to approach any of the panelists or speakers afterwards, obviously, for follow-on comment directly. And all the panelists today are here speaking and representing themselves and not necessarily the views of their respective companies and organizations. And finally, parts of today are being recorded for our members-only section of the website. If you haven't visited that, if you are a member, and I hope you do become a member if you're not, we do record all of our events and have these archived on our website, which is a great resource for you. And so again, the camera will be on stage the entire day, but if you are asking questions, your voice may be picked up as part of that, so just so you understand the recording aspects of the day. I want to thank our sponsors. We have the Pacific Alternative Asset Management Company, the Quant Network, the Berkeley Management School, the Haas School of Business, and UCLA Anderson School of Management. It feels somewhat like we're in a San Francisco meeting today, given our sponsors. And also, obviously, I want to thank our hosts, Goldman, who have consistently been very supportive of the organization. And with that, I'll hand it over to Leslie, my fellow board member, Leslie Rawl, who will take it from there. Leslie.
Thank you. Well, thank you for coming on a Friday this summer. Echo, echo. Unfortunately, Leo is in a cab. Last we heard he was at 34th Street. So we're going to start this program backwards and start with some of the open-ended questions I was going to throw out to the panel at the end and wait to the more structured part of the program till Leo can join us. Let me introduce the panelists. All the way to my right is Ann Yerger. The more detailed bios are in your material, but Ann is the executive director of the Council of Institutional Investors, which is one of the premier organizations that works with large pension funds and other institutional investors on many of the issues of the day. Very influential in that area. She's also a good friend of Mark Anson's, who is a former board member of ours and who I'm sure many of you know. Rosalie Wolf was the chief investment officer of the Rockefeller Foundation for many years, is currently on the board of TIAA-CREF and on several mutual fund boards, and has a wealth of perspective on governance and those issues. For those of you who don't know me, I spent 19 years at Citibank, 9 of them running the derivatives business in the beginning, the heyday of the 80s. I was on the ISDA board for 5 years when we drafted the first ISDA documents. And I run a company called Capital Market Risk Advisors, which advises companies of all types on all continents on risk management, risk governance, and litigation type issues related to complex securities. But I'm also chairing this panel in my capacity as a board member of a bank. And I'm on the CIBC Bank Board and on the CIBC Risk Committee. So one of the things that I'm trying to bring to the IFE, I've been on the board since the beginning in 1992, is some of the perspective for those of you who are more on the management and risk side as to how board members look at many of the issues so that we can improve the dialogue. So what I'm going to do is take it out of the context of what all of us do, at least I assume those in the room do. And I wanted to throw out a question that actually Rosalie raised. We have a little group called Broads on Boards, which is a group of women who are on major corporate boards. We had a meeting earlier this week, and Rosalie brought up a very interesting question. Actually, it was a two-part question. One part we're going to not address today, given our hosts. But what was, if you were on the board of Goldman Sachs or BP, what would you do? And so I think we'll leave the Goldman Sachs for another time, but I'd be very interested in sort of a dialogue on, if you were on the board of BP, what would you be doing? And Rosalie, since you brought up the question, go ahead.
Okay.
Well, let me, first of all...
By the way, note cards, so that if anyone, they've passed around note cards. If anyone has questions, please write your questions on the note cards. I'll be collecting them and trying to get to as many as we can.
First of all, I'm not a financial engineer, so I'm begging you to be kind to me. I was thinking about this, like, what did Mark Anson get me into this morning? But I'm really happy to be here. In terms of BP's board, Rosalie and I were talking before the program started, and I think at this point, first and foremost, the board needs to get out ahead of this. This is a company that has had so many gaffes, I think, in terms of how it's handled the PR aspects of what is now a crisis. I very strongly believe that the board's role in terms of risk is to oversee risk, but not to manage risk. That's management's job. So clearly it can't, it's not the one that should be dealing with the problem in the Gulf. I do think that there's a place now for a leader from the board to get out in front of the public to explain what the board is doing. I hope the board behind closed doors is doing a lot of soul searching in terms of its risk oversight performance and where it failed and what worked, what didn't work. I hope it's doing a lot of soul searching and assessments about what to do with senior management. I don't think that the time to change leadership is in the middle of a crisis, but I do think that anyone watching what's been happening has to be questioning the performance right now of Tony Hayward. And I guess I'll leave it at that and let Rosalie add some comments.
Sure, thank you. I am going to step back for a moment before we address BP and talk a little bit about what boards do and what they don't do, just so that we put it all in the same context. I mean, the title of our talk is Should Boards Do More? And of course, we would always think that boards should do more. But we also need to turn from a sort of finger-pointing approach to what makes the system work better approach. And so setting aside BP for a moment, the board, let's call it, of an operating business. This is a public operating company with many, many different kinds of operations around the world, right? The board's role is to oversee management. It is, at its most extreme, its job is to choose the CEO and to influence something about the choices of the top management team. Its role is to participate in strategy and to ensure that the implementation of that strategy is being undertaken with the appropriate level of values and ethics and effectiveness. So these are very broad comments, but that's what the board's role is. The board does not run the company, and the board will never be able to understand everything that's going on in the company because it doesn't have access to a lot of it. The bulk of its information comes directly from its management. It can influence whether it hears only from the CEO or from others, but it comes directly from that. It can call in outside advisors on all kinds of specialist roles, and often boards do. But when you put yourself in the role of the CEO, you're going to want a board that to some extent is supportive and reinforcing of what you're trying to accomplish with your management team at the company. So you're not going to have a board that's constantly sort of looking over your shoulder, checking whether or not they believe you. If they don't believe you, if the board feels that the CEO is neither truthful nor complete and is not making sufficient information available to them and they can't make that change, they need to change the CEO. But what they can't be doing is running a sort of parallel information gathering activity across all of the risk opportunities in that particular institution.
Can I just insert, because I think from the council's perspective, I agree with everything you've said, and I agree that the CEO wants a supportive board, but I don't think we're looking for it's the fine line between lapdog, supportive, and challenging, and I do think there's a role for the board to challenge management and the CEO on ideas and to push a little bit so that we're sure that decisions are being made, I think, in a very thoughtful and broad way.
And I would agree, and I should be clear about that. To me, being supportive is not agreeing to everything. Being supportive means getting on the wavelength of what the CEO's vision is, or the CEO and team, because there are different styles, and in some organizations it's very much a team, and in other organizations it's very much I run the place and everybody learns to work with me. Think Jack Welch, for example. So in that kind of situation, yes, the board must act as a sounding board and a challenging room, a place for really frank dialogue about what the company is doing and is not doing. And a board member who doesn't take that role seriously is not performing his or her duty well. I can assure you I have been on many boards, including the ones I'm on today, but on others over many years. I've never been on a board in which there wasn't active challenge and controversy around at least some issues of strategy or implementation. But at the end of the day, you get to a point where we've heard all the points of view, we understand that you guys approve and you guys don't approve, we've got to go forward, we're going to forge a way to go forward, and you've got to get a board or you get off. And if the board doesn't get a board, the board has to change CEOs. I mean, that's the reality. The board does not run the company, and you must remember that whenever anything goes wrong. Now, that's not to say that there isn't huge accountability at the board level. We're all sitting there wondering at what point is the board going to replace the CEO at BP. The problem with that is it won't have the single slightest impact on when they get that oil gusher under control. It won't affect anything. But more important is to look behind what's happened most recently and to look at the patterns of whether for a long period of time there have been infractions or whether this is an isolated incident. I am the last person to defend Exxon, but Valdez was an isolated incident. BP has a record of infractions, some quite large in public, others routinely in regulatory sites. I've worked for 25 years for companies that are in operating businesses. 15 of those were in the international oil industry. If there is a focus at the top with the board, with the top management, with people below that management on safety, both for human beings, which should be the very first safety issue, and human beings are the people who work for you, but they're also the people who will be affected if anything goes wrong at your facilities, even if they don't work for you. If that becomes a really major focus and that is implemented throughout the organization, it will have an impact. And you will see it in a lot of the reporting of small issues. The number of small issues will go down. And as one of my favorite former CEOs said to me yesterday, it is very rare for a disaster of this magnitude, the BP magnitude, to occur as a result of one mistake. It's a result of a cumulative series of mistakes. Now, we are all human. Not ever one of us is going to be perfect, so there will always be mistakes. And that's why you try to have a variety of control mechanisms, so if 3 fail, the 4th or 5th will hold. There were a lot of cumulative mistakes that related to this disaster.
If I can jump in on just the safety issue. I don't know how many of you are Morning Joe fans. I love it. My husband's got me on that. But they just had a segment this morning and contrasted the gross violations of the safety rules that BP has had over the past 5 years. It was like 860 versus under a dozen for other major oil companies. And I think that this is a place where you would hope, I think the board in its oversight role is asking questions, and I think the same case really would apply to maybe a Massey Energy. Same sort of reputation as being a company that's sort of been fast and loose maybe with the safety, its compliance with safety rules. Although obviously we didn't have sort of an epic disaster resulting from Massey, although there was extraordinary loss of life there. So you hope that the boards are asking those questions. I think actually, Rosalie, one point that maybe I would amplify is I think the board plays a very, very significant role in setting tone at the top and expectations in terms of the kinds of information it asks from management, the kinds of due diligence it does on issues. I think that any board, I believe, it had seen a trend where its safety violations far outpaced its peers, should be asking questions. And I think this is a case where you have to wonder, what was the board doing here? I think by not asking those questions, possibly it set a laxer tone at the top in terms of expectations in those areas.
Leo, do you have any perspective as a CEO?
Well, not on the BP. I'm the furthest thing from an expert in that field and would find myself not in a position to talk about the kind of questions that board should have asked or didn't ask. But on the issue of risks to a board member, if I could stick to that topic because that was the topic I was asked to speak of. I want to step back, if I can, with all of you, and tell you about an essay that I wrote in law school. That's back in the early 60s, on the issue in constitutional rights, when the question was the right of an opinion. And my essay stated that while constitutionally, of course, everyone has a right to an opinion, but in practice, that isn't very true, because if the issue is something, a nuclear fission, let's say, were I to offer an opinion on that subject versus a nuclear physicist, my opinion doesn't really count, and you might say I don't have a right to an opinion on that subject. In today's world, my essay is no longer correct. I was very correct then. It's different today, and I'll tell you why. You have something called Twitter, Facebook, YouTube, you name it. And everyone from the age of 7 or younger to whatever age you want has an opinion. And it can express it, whether they have that ethical right or practical right that I was talking about before or not. And they do. And if that opinion resonates with enough of the viewing public who also has the ability to offer their opinion in addition, they will do so. And it picks up a wave of momentum that in the 60s I didn't know about. And unfortunately, that changes things considerably for the risks of a board member and a director of a board. Because even if he thought or she thought they were not responsible, if the wave that's coming at them indicates differently, they become a victim, as it were, and their risk has changed considerably. For instance, I would suggest that today a board member has to think the unthinkable to cover his risk. In other words, when I'm sitting there in front of a board and I'm listening to, in the case of BP, what we're doing, or in the case of anything, and the CEO is telling us, and an expert comes in to explain that the CEO is right, or 2 experts or 3, I as a board member have to go beyond that. I have to ask the question that's the unthinkable, because I'm going to be held responsible sometimes for the unthinkable. And the responsibility will be a wave of opinion that will twist, maybe right or wrong, I don't know, but I become, as a board member, subject to that risk of opinion. It's unfortunate, I think, and it's putting too much pressure on a lot of board members. I think you're going to have this is a work in progress, I think, and that you're going to have change, and it's going to be. Board members simply aren't paid enough to know the unthinkable.
It's the best minimum wage job you could get.
Pardon?
It's the best minimum wage job you could get.
Could I push you a bit? Give me an example of a board member that's been held. What has happened to a board member who's not considered the unthinkable? I'm trying to, because
perhaps we should leave that till the end of the panel, because I'd really like to transition back to financial services.
But if I could just add an important statistic. We've just gone through a proxy season, and tens of thousands of directors have stood for election. And do you know how many did not win majority support?
Well, I don't know those figures. I do know that in Enron, there was a 25% liability on all board members.
Voluntarily. I mean, they voluntarily did that. They
That's my
settled the
point.
case
yes,
with that.
voluntarily.
And
just
that was
like-
one of, I mean, there have been very, very, very few directors who've actually paid out of pocket personally to settle a case, and they settled. They volunteered to do that, to settle a case.
I accept that. But I am telling myself and this audience that there is this feeling among board members that the risk is much higher than it used to be.
I would completely agree with that. I just am not sure we're moving into an Armageddon scenario regarding individuals' willingness to serve on corporate boards.
No, and I would agree with that, and we can come back at the end, because
Sorry,
Leslie,
Leslie.
I think, wants to get us back.
What I wanted to
We
do
should
is
get
sort
back
of
to financial
transition the
services,
BP discussion, which again was going to come at the end, but back to financial services, and just make the observation that the question that I would want to know about the BP board, in addition to everything, I agree with everything that's been said, but what kind of stress testing was done? And this is something we all in this room understand. And I can tell you, as someone who is one of you but now sits on boards, that one of the big problems is the way you present the information. And someone like myself who can sit on your side of the table and does understand the numbers and loves numbers, you parachute in for a board meeting, let's say even if it's once a month, it's usually once every 5 weeks, and someone gives you a page of numbers. And even if you're really good at reading numbers, you can't possibly remember what the numbers were the last time you saw them. So I think those of us, and I'm putting myself in your group, in my day job, have to do a better job of giving the board context, trends, and information, and maybe a little less data. Now, some boards will do a good job with that, and some boards perhaps will not. But I do think that this is very relevant for those of you in this room who talk about risk reporting and communications within your organizations, or those of you on the hedge fund side who talk about reporting to your investors. So whatever your day job is, I think there's some lessons to be learned in terms of that stress testing isn't only running a set of numbers, but it is putting them in context, and also adding to your stress testing, as Leo said, there are things that are going to happen that you don't expect. Things are going to go wrong. And I'm personally of the belief that we collectively in this room spend much too much time stress testing the obvious and not enough time stressing the subtle. And so with that, let's start with sort of a broader question. Given that we're dealing here with mainly financial services people and mainly people who are financial engineers, quants, risk managers, hedge fund managers, to try to make this a little bit more relevant to your everyday existence, I'd like to ask the panelists, do you think that boards understand the risks that their companies are taking? So, Rosalie, do you want to start?
Yeah, obviously some do, some don't. But let's come back to what that question means. I remember when the term financial engineering was invented, which was in the early 80s, it had a lot of, like any good invention, it had a lot of mothers and fathers of invention, so it sort of grew up. It didn't exist before that. And I gather your organization was founded in 92, so it took 10 years before people stopped. It was, by the way, a term of derision in the 80s. It was sort of a, like the way people talk about Wall Street workers these days, those Wall Street traders and everybody else who blew up the world, they sort of talked about financial engineers. They really didn't add value. And I say that just so that you hear the context. It was not the right context, of course. Now, to come back to Leslie's question, boards can't understand risks at the level of detail some of you do. For example, I was talking to somebody here who oversees models, corrects models, for an organization and looked at 1,500 models in a year. Well, there are no boards of directors of anything who will understand all of that. And of course, in any of our very complex organizations, and the financial world's not going to get any simpler, no matter what Congress does. It's not going to get simpler. It will just get more complex. No board will understand all the risks. But you can do a more orderly, you can take a more orderly approach to defining the kinds of risks. And I would say the first of these has absolutely nothing to do with modeling. You could apply stress testing to it, and that has to do with, that's reputational risk. And that is a thing that both Goldman Sachs and BP and any other organization I've ever seen, any business organization has that risk. So not all risks are subject to quantitative modeling, and some of the worst are not. The second thing I'll say, and it doesn't entirely relate to boards, but you could say, did boards appreciate boards of financial services firms, investment firms, did they appreciate the risks their organizations were taking? And the answer is obviously not. Did the management appreciate the risks? Clearly not the leaders. Were there some of you in this room who appreciated the risks and tried to convey them? Perhaps, and I hope you'll raise questions if you do, because I think one of the questions might be, how do people who in the organization who aren't the CEO and who perceive big risks, how do they ensure that that gets communicated so that the top management and the board have a chance of dealing with it? We have never had so many people employed, and I say we in the world, have never had so many people employed in risk management as we do today. And especially in financial services. Maybe we had more in 2007 than we do this minute. But we blew it, right? Risk management failed as an industry. So it's worth learning from that, and the boards need to learn too. My question was, would you really rather be on the board of Goldman Sachs or BP? And that, I think all of us would happily just go home today.
Leo, would you like to?
Well, the topic we deal with daily, and I agree with almost everything being said. In our world of futures markets, we did not fail. So I just want to make that distinction.
Mm-hmm.
Our markets did work exactly as they were supposed to during the worst disaster in financial history, at least in our lifetime.
Including, what do they call it, the flash crash?
No, I was speaking rather...
Okay, I just mean things come at different times.
Well, I'll speak to that if you will, but I was not referring to that. I was referring, I think, to what was being referred to as the 2008-09 meltdown, and that during that worst crisis in our history, the futures markets did not fail. In fact, they carried out their function without any need for federal bailout or funds or service of any kind. That doesn't mean it won't forever be that way. I don't know. Because again, if I want to think about the unthinkable, I have to think about the time that it might not work. But at least it did during this very terrible crisis. That's not to say, however, that what Leslie said in terms of information that is given to us as a board, we can know everything that is being done and understand everything that we ought to. It's very, very, very complex. We have many board members, far too many, I personally think. But we were caught in mergers and acquisitions and under legal contractual obligations. Our board grew to a point that it presently has some, I'm going to say, 30 or so board members, and that's far too many. To think that all 30 of us know every item that is being discussed to the extent that the CEO does, of course not. Or the question, it sort of begs the question, who are these board members? Now, in our case, mostly they are people with some connection to the industry, so they have some knowledge of what the futures markets do, and that's helpful. But the issue of independence comes in, and we have to have a very large percentage, some 30% or more, that are independent. And by definition, independent really creates a problem for us, because if you come to our world and are truly independent by definition, I mean, this is like, to you, the newcomer, Alice in Wonderland. And so how can that person be expected to understand all the intricacies of a euro-dollar spread or a credit default swap or what have you and know what the risks are? It's an impossible equation. We try to give everybody as much information as we can. And most of the board relies very heavily, frankly, on the management. And sometimes doesn't even know to ask the question that an insider might ask. And so they rely also on the experts on the board, not management, but the people on the board to ask those questions. And a good combination of that, I think, produces the most effective and I think holistic capability of managing the company. So I guess what was said was that information, I think you said, or somebody said, that the more information, the more put in context, the more that is explained, the better this board can function. And you have to go out of your way to be transparent to the board members so that they are instigated, as it were, to ask the hard questions, even when they are new to the game. That's the goal we have, and so far it's worked pretty well. But, you know, I think it's a work in progress because, as I said, we are being challenged after the fact. It isn't anymore before the fact. I mean, BP's board members, I don't know how many there are, but they're being challenged by an event after the fact, as is the case in Lehman Brothers, for instance, as is the case in Enron. These are people who did not expect what happened, I'm sure, and it happened. And then they were being challenged and held responsible one way or another, whether it's reputation or in money, certainly in reputation, for what happened. So it's after the fact. So we have to have that mentality today, I think, to protect yourself as a board member, knowing that you're going to be expected and be held accountable after some event that you didn't think about happened.
And without beating a dead horse, I really agree with what everyone has said. I think we're at a great place, to be honest with you. This is the Lemonades from Lemons story, but I do think that boards of all companies, whether it's the financial sector, the energy sector, I think all company boards right now are really trying to get their hands around their risk oversight responsibilities and assessing whether they're doing a good job. I think there have been 3 impediments to really effective risk oversight by boards. I think the first is the communication issue that Rosalie noted, and I just wanted to throw out a statistic. As I was prepping for this, I looked at some studies. There was one, a 2009 study done for the AICPA of 700 entities, mostly CFOs. 78% said they did not formally define risk. 75% said that key risks were communicated within and to management only on an ad hoc basis. 74% said they provided no reports to boards describing their company's top risks. I mean, I was shocked by some of these numbers. 44% said they did no formal assessments of strategic market or industry risks. This is quite extraordinary. I think that this is changing. And Rosalie, I think, noted a really important point, which is where are you getting in the information? I think one thing we've learned from the crisis is that at times risk assessments within management can be siloed and no one is sort of stepping back and looking at it from an enterprise standpoint. That leads me to impediment number 2, which I think at some places there's been structural impediments. According to a recent NACD survey, only half of the boards said that they had any kind of enterprise risk management system in place. There's some kind of formal program to look at the overall company risk. And I think that's an issue. I think you brought up an interesting point. Another structural friction has been this issue of independence of directors. There are requirements and indeed expectations that a significant majority of boards are independent. And I think there's a tension there when you're adding independent individuals who may be divorced or removed from the industry at hand. I do think that leads me to impediment number 3, which is the skill set issue. I mean, risk is extraordinarily complex, and I don't know that you can expect that a board has fully the expertise on it to even know what kind of questions it needs to be asking. I think boards over the years have been really good about, first of all, retaining legal counsel. They've done a better job, I think, and of course they've always had sort of, and I think since 2002, post-Enron, I think they've done a better job in terms of overseeing the financial counseling they may get from the audit firms, because that indeed is the board's duty. Recently, I think there's been a lot more reliance on compensation consultants, for better or for worse. So those experts, I think, are increasingly being used. But I think that boards need to think a lot broader in terms of the expertise they're lacking, and rely on experts, particularly in this really complex issue of risk oversight, so that they can do a better job.
I can tell you that in our practice, we're doing a lot more work directly with boards on education in these areas of risk, but also that one of the things that I find the most important is teaching them not the facts and not the understanding of the complex products that, Leo enumerated, but how to ask good questions. Because a board's responsibility is really to ask good questions, not to know the answers. It's to ask good questions and have enough common sense and wisdom to distinguish between good answers and bullshit answers. So I think that process of asking questions, I'll just make an observation on the Canadian board that I sit. One of my favorite board members recently retired, and he was one of my favorite board members because he asked the best questions. And then we look at all of this business about boards having to have people with certain skills. What was his background? He was a farmer. And he'd built a big enterprise in Nova Scotia, but he had just that ability to listen, and then sort of that wise person ask that very penetrating question. And I don't know how you put that into a disclosure questionnaire or how you go after that, but that is an extremely important skill. And it's also a skill that can be improved with training. So I think that that's an area.
That's true. And I would say that, with all due respect to the futures industry, which might have suffered a little more if the government hadn't bailed out all its players, I do think that people from outside a particular industry, and sometimes people from outside a particular age stage, can ask really good questions that all the experts have not thought to ask. And I found this over and over. Somebody from outside the perspective asks a basic question. I just want to say one thing about your statistics on risk management, which don't surprise me a lot. Outside the financial services industry, there are very few risk management committees. And risk management, I sometimes call it the Chanel of our age. It is a fad. I mean, it's an expression which is so broad that I believe it covers everything involved in running a business enterprise. I can't think of anything that's important to a business that doesn't pose some risk. Therefore, risk management equals the business. And to me, when you use words so broadly, they lose their meaning. Now, what's happened, of course, is that different enterprises, everybody thinks you should be focused on risk, so different enterprises adapt that term to something they think is useful for their enterprise. But it doesn't surprise me that we get these answers, particularly from the sort of the CPA levels, because you're getting, you're not getting to the discussions of risk that happen in the boardroom. I will just say one last thing. I think to me, on the whole, I was quite receptive to Sarbanes-Oxley when it got passed, because I thought it will make us all better at identifying our control risks and remediating them. I've now found in the last decade or 8 years since it's been passed that almost all the risks in the organizations I've had anything to do with did not surface through the Sarbanes-Oxley process. Those processes went fine, they got signed off on, and the problems arose anyway. That, to me, said that, and they didn't arise because of some technical quantitative thing. Although often there were mistakes. I mean, they were in a mutual fund, they arose because of valuation errors, for example. That is quantitative, and quantitative analytics are extremely important. But that wasn't what gave rise to the mistake, and it wasn't what gave rise to the mistake, which after it was fixed, became the same mistake 3 months later, right? That's a process problem. So these are the kinds of things that organizations say, okay, we need to do risk management. What does that mean for our organization? How do we make it into a functional expression of values. But I do think right now, risk management's got to be done in the financial industry. It better be done differently than we did it in the past, because it did more of it than anyone else, and it lost it big time. But the rest of the industries, and there were many, that by and large did as well as they could, given that the financial world collapsed, they basically kept on trucking. And a couple of years later, they're doing pretty well. And they still don't have risk management committees. But that doesn't mean that they're not addressing key risks.
It's thrilling that we've gotten so many questions, but we're obviously not going to be able to get through all of them. So I'm going to try to group them. And the panelists, please don't answer each and every one subcomponent. Just pick out the thing that you would like to comment. There was a series on stress testing that included, to stress test the unthinkable, what framework should you use? A typical stress testing framework is based on some type of historical analysis. Should every board demand to be shown at least one scenario in which the firm fails? How can a board determine whether practices, processes have contained risks relevant to the company when practices are so similar across the industry? So in that general theme of what it is that we're stress testing and how we might think about them. And again, if you don't have a particular, there could be lots of topics for everyone to talk about. If you don't have something that you think you want to say, that's perfectly fine. But Anne, do you want to?
Well, let me just make a quick comment on the living will question. Yeah, I actually do think every company there should be some thought about what's going to happen if the company goes belly up. I think that was actually going to be legislated for financial firms. I don't think, are you following? Who's the person following the regs? I'm not sure it's in the final rule, so yes, I think that makes sense. I'm not sure. I'm sorry, I don't know if I fully heard the stress testing question, so I'll defer to the other panelists.
Well, of course, in our world, we do stress test not only ourselves, we stress test the clearing members and the positions that they hold. And we do often demand whatever we think they ought to be doing to accommodate what the results of a stress test may be. And that was true when Lehman Brothers collapsed as well. I mean,
right, but with all due respect, I'm quite familiar with the stress tests that are done, and they generally fall in the classic realm of stress testing against things that have happened in the past. Mm-hmm. And I think what the state of the art is that we're all struggling with, both as board members and wearing day hats as risk managers, is how do you stress test against potential events? And one of the things that I found very useful is to actually ask the board, as hopefully wise people with a bit of gray hair and perspective, to come up with their nightmare scenarios and use those in addition to the classical stress tests of what has happened, but to look to senior management and the board and to ask them to blue sky what are some of the circumstances that they don't think will happen, because obviously if you thought they were going to happen, you would not have those exposures, but that they are concerned about. And I think that's a very important new aspect to stress testing that I'm seeing focused on more and more. Rosalie, do you have a perspective on that?
It's not really on stress testing. It's very simple. Another one of my favorite CEOs said this to me when I was asking what the risks were he was most concerned about. He's a board member, of course, as a CEO. And he said the risk of silence. And I love this one. I do want all of you to hear it. It's the risk that someone, as he described it, the risk that someone in the organization will see that there's a problem with something important that we're doing and will not speak up. And that, I think, I've never heard anyone put it quite that way, but I'm guessing that most of you are in places where that you might be in a position of seeing something that could be really terribly destructive, and you might have to consider whether and how to speak up. So do it.
And let me just
There
add,
are actually two related questions to what Rosalie that I would just sort of put in now in the mix. One is, and again, these sort of surprise me because I have honestly never seen this, but does a corporation as a legal person have a right to keep dark secrets? And when voting, do your boards use secret ballot or transparent process? It doesn't matter. So there seems to be an impression, at least among some, that there are secrets kept, and certainly not been my experience, but I'd lever off of what Rosalie said and see if that's perhaps others.
Well, I have not found that that happens very often at a scale where, you know, you really worry about. It's not a secret of whether someone has a girlfriend. We're talking about real secrets that count for the corporation's well-being. And I think for the most part, at least my experience has been, that that is not possible. It's possible, I understand, but it doesn't really happen in my experience. What I can thoroughly agree with is the keeping silent when you are thinking something might be wrong or could go wrong, and you don't ask the proper indicated question. That is a serious mistake, even when it isn't a secret. It's just simply bringing something out that might otherwise not have occurred to anybody else around the table. So do speak out, and that's when you run into this, this comfort of thinking to yourself, well, maybe I'll show my ignorance by asking this question. I recommend show your ignorance, because it's probably not an ignorance. It's probably something that's going through the mind by others around the table, and if everybody's uncomfortable about asking the question, it'll never be asked, and it's better asked. And you'll usually find that there's a few people around the table are glad you asked what you might have thought was a stupid question, but it brings out something very important. Silence is a curse. I thoroughly agree. Around the boardroom, that's the curse. And we, at least my experience, which is a lot of years, is to encourage. I used to put the squeaky wheel on the board, who I disliked for being a squeaky wheel. But sometimes, every now and then, that squeaky wheel asked the question that was very, very important to ask, and no one else did. So encourage adversarial people, even, to come on the board. I really encourage that.
Just really quickly, I agree on the speaking out. I do think there's a board duty here in making sure there's an environment that can accommodate that, because I think the real world does interfere with this, and that is that people don't want to lose their jobs. And as a result, I do think there's an important role for the board in making sure that there are avenues, safe avenues for individuals to essentially blow a whistle, if that's what we're talking about. Let me just talk quickly about, I don't think boards act by secret ballot. I think generally decisions are made, at least I'm on non-public boards and private company boards, and we do not do anything by ballot. I mean, we sit around the table and you own what your vote is in front of your peers after you've discussed something. Regarding the legal question, I think it's a very good question, and to be honest with you, I'm not a lawyer. I don't know the answer. There was a very controversial proposal that the SEC had many years ago, just post-Enron, that would have required the law firm to sort of go up the chain if they identified a problem. That rule was never put in place, so I do think that there's probably some attorney-client privileges that don't necessarily go to the board or have to go to the board. But Rosalie, you might know better there.
I don't think I can comment on the legal technicalities. But I guess I'll just amplify a couple of things. First of all, not everything that happens with the board happens in the board room. Board members are full of human beings. It is sometimes very useful to have conversations outside the boardroom, to trade ideas among a few people, and to get a sense of whether you're in the lunatic fringe or you represent a perspective others have not previously considered and would like to think about. So you get a certain amount of thoughtful debate that may best take place not in the boardroom when you're always on a limited schedule and you have 10 or 30 people all trying to process and vote on something. The second thing I would say, and my most graphic experience of this came in my day job, which is serving as a consultant to boards, when I did some work for a board of a large public institutional investor who's one of your clients. And that board had to always meet in public. So there were not only anybody could walk into the boardroom and sit down and listen, but that also meant that members of the press were there and could quote anything that was said. And it also meant that other constituencies in this public environment, which had to do with employees and beneficiaries and so forth, could be there and read, listen, and ask questions. What I learned from this, and I now apply this to Congress, is I had met with every single one of those board members, there were quite a few, but in doing the work I did with them and in summarizing my recommendations. And I made the recommendations at the meeting, and I had told them ahead of time what they were going to be. It was all very well vetted. And at least half a dozen board members challenged a recommendation publicly that they had themselves made. And I thought it was so wonderful, interesting. I mean, I learned something I didn't expect to learn, that people in public will take a different position from what they believe. Guess who does this all the time? I sometimes think if we took Congress, if we took the television cameras and all the reporters out of Congress and let them have debate among themselves as if they were a very large board, but we took everybody else out and let them debate the issues on the merits for their needs, they might actually become better legislators. The application of that in the boardroom is to have more executive sessions, which means sessions without management present, sometimes with the CEO, and we try to, in the boards I'm on, we try to think about how much of what we're talking about is it best to talk about with the CEO present, because he or she can actually do something about what comes out of these. And then, but we always have a session without the CEO, because that allows some of the board members who maybe weren't quite as comfortable indicating some concerns to discuss them directly. And that has been a terrific evolution.
And I always recommend that boards also have an executive session with just the CRO. And I think that's also a very effective.
If there's a CRO, that's one of many. Although we have to have one with the auditor, we have to have one with the chief compliance officer, we have to have one with the CFO, we have to have one with the internal auditor, and we do add the CRO in the places where we have CROs. But as you can see, these can degenerate into formalities. So I try to talk to some of these people ahead of time and say, is there anything going on that's important that we need, if I chair the committee or the board, that we need to allow time for, so that we actually program in the time for those executive sessions with the key person as much as possible.
Since we're officially out of time, I'm going to combine 6 different questions and ask each of the panelists to answer any one of the variations and allow them each about a minute so that we cannot go too far over our time slot. The questions that I'm going to combine seem to fall into the following categories. Are board members paid too much? Are board members paid too little? And the other parallel set are board members sufficiently accountable, and why would anyone in their right mind be willing to be a board member today? So with that as sort of the framework, pick any one of those 4 quadrants and offer your opinion.
Well, I've already stated my opinion that for the risks involved in today's world, and as I say, it's a work in progress because of the communications that I've indicated, with public opinion having an effect on the risks that are represented to the board members, reputational to a great extent, the payments are quite low. And one has to wonder why people would serve on boards that have that kind of risk, and that's in the financial arena, I think, unless the payments were sufficiently attractive. So I'm not talking about the kind of money you see in the papers that CEOs might receive. I'm talking about and I don't know the average. I mean, you might know what the average is, but I think it's on the low side. And I think it's going to change as people recognize the risks that I'm talking about that are increasing. And I think that'll be a good thing.
Rosalie? anyone?
I think most board members serve for reasons other than pay, and occasionally you encounter a board member for whom the compensation, however much it is important to that person's overall life. That's generally a big negative because they don't want to threaten their compensation. So, but by and large, that's not the case. I think board members serve for the reasons, similar reasons to the role many people take on in public service or in the political arena or in social service, in jobs that by the standards of the finance industry don't pay very much, and they get a lot of other kinds of gratifications out of it. So bottom line, I would say there's only one necessary qualification, one necessary reason to serve on a board. There are various sufficient ones. The necessary one is you have to want to and think you can make a contribution to the health of that enterprise.
Boards are not sufficiently accountable here in the United States. We have emerging markets with better standards for director accountability. It is hard to believe that here in the U.S., even if in most companies, if a director has more votes withheld than cast in favor of the candidate, he or she can continue serving. There isn't majority voting for directors. The costs, impediments to owners to run other candidates is extraordinary. Those mechanisms need to change, and they're stronger in countries like China and Russia, and we should be embarrassed by that.
I want to thank the panel, and I want to thank the audience for asking so many questions and making this a very interesting and participative section. Thank you.
We're starting in about 2 minutes, so don't go too far.
So I can do it from my seat?
Yeah, you can do. Do you want to do it from your seat, or do you want to? I think you should do it. I'll do it from. Okay. Basically, he knows the order, so.
Oh, you think this will be okay? In other words,
He already knows the order. So basically, he's going to see when you get up there. That button's up. I'm just going to do it quick. All right, so we lost a few people, probably, but we'll go ahead and get started again. Good evening. We'll start. Good morning. Evening, not evening yet. We're going to start our next session on financial reform. For those of you who came late, just a couple of housekeeping reminders. The IFE press policy is that IFE events are off the record. Members of the press are reminded of this. If you would like to have any comments from panelists, you may approach them afterward for follow-up. And also that panelists today are here on their own behalf. Their views are their own and not necessarily that of the respective organizations. With that, I will hand it off to David Martin, who will be starting us off today. We're going to have 3 presentations, 15 minutes, 15 minutes, and 15 minutes. At the end, we'll have 15 minutes of Q&A. We won't have a moderator. We won't have index cards, so just shout your questions out, and the panelists will answer from there. Thank you.
Hi, I'm David Martin from Alliance Bernstein. I think I've sort of entitled this one, The World According to David Martin. And as a former chief risk officer, and now working on government affairs, because we probably all have the government as our partners today. So I entitled this, How Regulation and Government Action Will Shape the Capital Markets Landscape. And what I wanted to do is first give you a macro perspective as I see the world and what this financial crisis has done. So the first, there's winners and losers in every game. If you take a step back, probably China did the right thing in terms of stimulating their economy in terms of infrastructure. U.S. probably came out okay, and maybe Europe is going to be the big loser here as one major viewpoint. And then if you take a step back and you say, okay, I always talk about the discipline of debt. People who go into that discipline come out of it with a different perspective, but certainly see a lot less free expenditures. You see a tighter rein. That's also going to have an impact on consumption and growth. Now, we also think about this increased political change that's happening and the backlash. Now, most people say in Washington, D.C., that it's really Wall Street against Main Street. And people think about it in very different ways. So if you look at Wall Street, and I'm going to be a little sort of out there on this one, but I'm just trying to illustrate a point. Wall Street says, look, we did a trade, we borrowed money, we paid you back with interest, we're done. Let's just move on. Main Street says, hey, we saved your life, you owe us forever, we have more votes than you, and this isn't going to happen again. So things got to change. So you have to look at it from the perspective in terms of where people are coming from. And that will have an impact. There could be, because of lower job opportunities, more social unrest. You will have a backlash against business, and you will have potential for change because people are not happy. If you look at the legislative developments, okay, well, one of the things that I keep thinking about is retirement. You have an aging population. That problem did not go away. And that problem has just been accelerated in terms of the impact that this has had on people's savings for retirement. So you could see, and I'm not saying tomorrow, but you could see over time a real wave of legislation in terms of retirement benefits. And lastly, which I think is a very, very important topic, and particularly germane to risk managers, is this trade-off. What we are doing is trading off lower growth for some perceived safety net. So if you're going to have more safety and you're going to restrict, the flow of credit, you're going to have slower growth. So let's just explore that a little bit more in terms of lower growth. Okay, I do think that the engine, asset-based finance, not what it was, maybe hasn't been, maybe ground to a halt is a bit too much, but it's not where it was, and it's going to take a while to come back. Core credit, very difficult to get these days. Look at the amount of people buying houses and the difficulty they have. Now, the next point I think is an interesting one. When you have more government intervention, and you're uncertain how the government's going to react when you come out with a new product, and you're uncertain how the government's going to react when you do something, okay, that's going to create a higher level of uncertainty. That's going to create a roadblock. That's going to put a stoppage to some point in terms of new creativity, new ideas, and bold things. I also think that because the developed world markets will be so highly regulated, that there'll be a huge growth exponential in emerging markets, and you'll see more and more growth in that area. And lastly, when you start proprietary trading, say what you want, but there's a lot of liquidity that comes into the market because of that, and that is going to be diminished. Also, if you take a look at the ability of investment banks to, they have the ability to lever themselves up, and as a result, they can do transactions that smaller players cannot do, that there might even be better spreads as a result of all this, because there'll be a little less liquidity, but a lot less competition. Now, in terms of this perceived safety net, so if you're going to trade off growth and you're going to do that for more safety, do you really have the safety? So the first point I'd like to just throw out there is that has risk-based capital worked? You know, if you look at the history over the last 10 or 15 years of regulation, it's all risk-based capital. It's, you know, have more capital to take care of risks that you're not even, you know, existing risks, risks that you haven't thought of. It's all based on risk capital. Have more capital. Well, did more capital help? So if you think about, let's say, liquidity and liquidity risk, did more capital help liquidity? So if you wanted to sell your house at 3 a.m. in the morning and you woke up and took a sign and you put it on the front lawn and said, house for sale, you know, what would the liquidity be at 3 a.m.? Even if you had a lot of capital, you know, would that help you? So we need to think about capital in a different way, A. And B, is if you have your whole legislative approach to having more capital, is that really a way of creating more safety in the system? Maybe not. I think the second point is if you have to have more capital, well, you know, it's assets minus liabilities equal capital, right? So if you have to have more capital, and one way of doing it is having more leverage. So to the extent that we look and say, well, leverage is bad, but capital is good, but if you want to continue the same level of business and you have to have more capital, well, you're going to have to increase something, right? And that might be leverage, and you might see much more leverage in the system, which might not have the safety that you think you're going to have. Now, this is very controversial, the next point, because people over the last couple of years since Lehman have said, oh, man, counterparty risk. Whoa, off the charts, very important risk here. But, well, one second. One of the things that I think about when I think about counterparty risk is I call it entanglement risk. You know, the situation where you have a counterparty like Lehman, you have some assets with them, you get stuck and you're entangled and you can't get them out. Okay? Now, if there are orderly, you know, if we're going to have a world coming up with this new financial regulation of orderly dissolutions, well, we can't let Lehman happen again, so we're going to backstop it. I mean, how, and we're going to take all the collateral and we're going to put it in a depository, third-party depository. So we're going to try to reduce this entanglement, and we're going to reduce the amount of kind of exotics that you could do and sort of standardize things. Does counterparty risk go up or counterparty risk go down? So as a result of all this, maybe counterparty risk becomes less important. And the last point I'd like to make is, if we look at hedge funds, there is a process in the way where hedge funds have become more and more institutionalized. And what do I mean by that? They have risk managers, they have compliance officers, they have infrastructures, and they have large amounts of assets under management, larger amounts of assets under management. And if you want to be acceptable, you know, why does Willie Sutton rob banks? Because that's where the money is. Well, if you want to get AUMs from institutional investors, you need to have certain things, right? Because an institutional investor is not going to take large amounts of money and give it to someone that doesn't have the proper safeguards, the proper third-party providers. So what's happening is that the hedge funds are becoming much more institutionalized and much more client-friendly to institutions who have all this money they want to give them. Well, in the case of the last 2 years, what we've seen is that hedge funds have become more and more institutionalized, and this trend will accelerate. And the legislation will help it accelerate, because if a hedge fund is going to be regulated by the SEC and it's going to have to report to the SEC and there's going to be disclosure, okay, you're going to see this process even speed up even more. So I talk about this impact of financial reform, and there is a trade-off of lower growth because you're not going to have the credit formation or the innovation as quickly as you had before. But you're not going to have the safety or the perceived safety that most people think, because it may be illusionary in a sense. And lastly, I just wanted to conclude with the result of this financial reform. And it really relates to the supervision. First thing, I would tell you that in terms of the legislation, that train has long left the station, and there's very little any of us in this room are going to do to influence it. What's really going to be the battleground, or the place where people are going to focus on over the next 6 months to 2 years, is taking the legislation and the process to making it regulation. Because how you interpret what Congress meant, okay, and putting it into regs will have an enormous impact, okay? And that's where the battlefront will be. Anybody that's good at government affairs, okay, knows this, and we'll be focusing on the people who are going to make the legislation into regulation. And let me tell you something, the government doesn't have enough capability to do that. They will have outside law firms do it, okay, and there'll be lots of input that will come in terms of making that legislation into regulation. Second point, make no mistake, hedge funds, derivatives, securitization, private equity, consumer finance, rating agencies, and exchanges all will be impacted. I could talk to you, I could take questions in terms of each one of them, how I think it might play out, but each one of those players are going to be impacted. Now, you have not seen enforcement in the United States the way you're going to see it. If people thought it was bad in Europe with the FSA, okay, you haven't seen anything yet. I think you will see the SEC. I think you will see all the regulatory agencies become much more stronger in terms of their pursuit of criminal investigations, in terms of the persecution. You're going to see a much different environment. I always like to say that every financial crisis needs to see some villains. You need to see somebody, with their hands cuffed being marched out. Okay, that picture, okay, happens in every financial crisis. We haven't had enough of that. You will see more and more of that kind of activity and that kind of approach. Now, the next one I think is interesting. I say risk management will finally get a voice at the table. My friend Tom Donahue says, well, wait a second. Can you be an ornament? Can you have a seat at the table, a voice at the table, a vote at the table, or a veto at the table? I just thought it was so interesting. Thank you, Tom. The point is that what about risk management? Where is risk management in the process? Is it built into everything that we do? Will it have a bigger say? What will change as a result of this crisis? I think there's going to be huge changes. The last point that I'd make is that the major change is going to come in the following front. And it sort of parallels what was said at today's earlier session. I think boards will become much more proactive. They're going to need to understand the risk exposure. They're going to need to understand risk relative to earnings, relative to capital, relative to appetite, and relative to long-term sustainability of the company. They're going to have to think about risk management in terms of organization, in the sense of, are risk managers really empowered? Is risk management inherent in every strategic decision? Okay, and is risk management integrated into everybody's job? So that is sort of a summary of how I see risk management in terms of how it impacts the capital markets, its regulation, and sort of David Martin's view of the world going forward. Thank you.
Let's see if I can get this to work. Well, my slides are really not all that important, but so I'm Connie Volstad. I'm the CEO of ISDA, the International Swap and Derivatives Association. I have just come back to work after a couple of years of retirement. I was on the board of a credit reinsurer and saw the most ungodly pieces of of risk that I'd ever encountered. I had about 30 years or so in the financial services industry, and when I got a call from the ISDA board asking if I wanted to come in a senior position, I was delighted to do that, and I'm delighted to be here. ISDA, by the way, has been around about 25 years. We have 850 institutional members in 50 countries or so. We work on a number of derivative-related projects, including a lot of infrastructure building that we do in conjunction with the various regulators around the world, and there's actually quite a lot of work that's been done. I do have a background in derivatives since the early 80s, long before ISDA was around. I used to consider myself to be a little bit of a financial engineer, I guess, although back then we called ourselves geeks. I hope that ISDA can get more involved with the Association of Financial Engineers, because I think there's a lot of synergy there. I'll be talking today about a pretty mundane topic in terms of financial engineering. It's what's likely to come out of the U.S. financial, I'll use the word loosely, reform that's going to probably be signed in the next few weeks. By the way, experience in markets and derivatives does not give you the proper training for dealing with politicians. I'll look at two scenarios, if I can. Oh, I got it. No? Two scenarios. One is what I call a moderate clearing scenario, and this will be mandatory clearing for certain items for certain counterparties. And it also require some exchange trading, and I'll go through that. The second will be a more severe scenario for both clearing and exchange trading. Then I'll talk about a provision that's in the current bill, which is the push-out provision from Senator Lincoln. There's a very good possibility that will itself get pushed out, or it'll get phased in over a couple of years. I'll spend a bit of time then about the unresolved risk issues that the financial reform is just not addressing, or not addressing properly, and then conclude. So, if I can... First, a moderate clearing scenario would require that the vast majority... Well, I'll look at a scenario that would be something that would occur about 3 years hence. In 3 years, I would imagine that the vast majority of all derivative products will be clearable. Right now, interest rate swaps are clearable, and credit default swaps are clearable. By the way, I probably would surprise you if I told you that the dollar amount of interest rate swaps that are currently being cleared exceeds $200 trillion. So it's a very, very large number, and that number will go up very, very significantly in the future. We imagine that there will be an exemption for end users, corporate end users, and perhaps for smaller financial institutions. A few years from now, we think there'll be a number of clearinghouses. There'll be one dominant clearinghouse per asset class, but I think there'll be more than one clearinghouse per asset class, although it'll be dominated by one. The exchange trading will be involved standardized cleared products, and they'll be done both on exchanges and something called SEFs, swap execution facilities, which I think can be rolled out in the relatively near future. If we look at the products that will be clearable, as I said, right now we can do plain vanilla interest rate swaps through the London Clearinghouse. They are working on a number of different products. They'll be working on, and these things should be rolled out within about a year and a half. The risk management, the bankruptcy management is a very tricky thing, and it must be handled with an awful lot of safety. But they'll be rolling out FRAs, option products. They have some basis swaps that will continue to expand, cross-currency swaps, and probably within the 3-year period, municipal swaps. With respect to CDS, we now can do, in the next 6 months, we will be able to do virtually all the indices and about 200 single-name corporates. Over a 3-year period, one can certainly imagine that virtually all the indices, tranches of the indices, and thousands of single-name CDS will be clearable. In the equity and commodity derivative space, we think that will be largely standardized products. There's an awful lot of bespoke transactions and unusual indices that occur in those products. The exemption for the end users and smaller financial institutions with respect to clearing they'll still have the option to use clearinghouses as a means of managing their counterparty risk, but there won't be a requirement to do that. We think that there will be segregation of collateral both on a bilateral basis and obviously through the clearinghouse. We did some work in looking at the Lehman bankruptcy and studied all of the claimants that exceeded $20 million. And there were, I think, 275 claimants. Several of them were Lehman entities themselves. But if you looked at the non-financial corporations, there are only 5, and the total amount of claims was about $275 million. Not a very, very large number. The biggest was a Swiss aluminum company that was $80 or $90 million. I excluded from that one transaction, the Giants Stadium of all, that got caught up with selling auction rate debt and had a problem with the monoline that was backstopping it. So we don't think that there's a requirement that we don't think corporations should be required to use clearing houses. The number of clearing houses, as I say, now we have the London Clearinghouse in London doing interest rate swaps. ICE is the biggest clearinghouse for CDS. There are a number of other clearinghouses that have started or are in the works. There are all of the Asian countries or all of the significant countries out in Asia are trying to develop their own clearinghouses. And so we see in 3 years' time that we'd have quite a hodgepodge of clearinghouses. As I said, I do believe that for each asset class there'll be one dominant clearinghouse. And the conditions for membership are quite onerous for these large clearinghouses. They require that their members, first of all, do straight-through processing so that everything can be done electronically. They also require the members to have significant financial resources. Obviously, a clearinghouse that has $210 trillion worth of contracts needs to have a very, very resilient bankruptcy scenario stress test. And it will require strong members to deliver the resources that would be required. The membership requirements also will typically require a secondment of staff in the event that one of the members goes bankrupt. That staff will be seconded from the members to the clearinghouse so that they can unwind the risk. There'll be rehearsals for these scenarios, and it does require a significant commitment. Finally, the members have to agree to bid on the positions in the event of a bankruptcy of a member. And by the way, in the case of Lehman, I think they had $8 trillion or 8 trillion euro, I'm not sure which, of swaps with the London Clearinghouse. And the Clearinghouse was able to, A, hedge the risk, and then B, sell off the portfolio. And they used up just about half of the initial margin that Lehman had posted. So it did not strain the members at all, and in fact, the remainder of the initial margin was returned to the estate. We think that in addition to having the large clearinghouses, there may be smaller clearinghouses that may have less onerous membership requirements, obviously because they'll be smaller, and you might also be able to create clearinghouses where the client collateral requirements will be less than what they might be with some of the other clearinghouses. And if that is the case, then instead of and the collateral requirements for clients are the initial margin requirements, And so if initial margin requirements are reduced for certain parties to the clearinghouse, then you'll have to find that the clearinghouse would have other capital demands on members. I think the way things are headed, that most of the large investment firms will become clients of members. They will not be able to, they won't want to become members because of the onerous requirements that they would face there. One of the big issues about clients dealing in a clearinghouse is that the positions can be moved from one member to another in the event of a bankruptcy of a member. This is called portability, and what the London Clearinghouse does, for instance, is they tell the clients of members that if the member goes bankrupt, they will try to move the position to another member. If they fail to do that, they will give the counterparty, the client, its collateral, the net present value of the position back to them. They urge their clients to find a backup member in the event that the member they're dealing with goes bankrupt. Clearly, segregation of collateral is important for the clients of members. They wouldn't go through a clearinghouse if they didn't weren't able to get their collateral back. One of the big issues that regulators are facing, and it's very, very important, is that you don't convert the inter-dealer counterparty risk and the entanglement that causes, and the interconnectedness that causes. And indeed, that is an issue that the derivatives market has to face. But let's not just move the risk from one of the big banks to the clearinghouses. And it's very, very important that the clearinghouses are constructed in a way that they can survive multiple bankruptcies in a very, very stressful market environment. And it'd be important that they're properly regulated, and indeed that they use risk management techniques during the course of time to reduce the notionals. We've been working with the London Clearinghouse we meaning the industry, to compress transactions. And over the course of the last 5 years, the industry has compressed about $100 trillion of transactions. It's being rolled out now in the London Clearinghouse, and probably $10 trillion or so will be done this year. We're working on another very, very aggressive and process to perhaps reduce notionals in the London Clearinghouse by $100 trillion or more next year. Well, so systemic risks in clearinghouses are something that we need to be concerned about. I mentioned before that standardized cleared products will be executed either on exchanges or swap execution facilities. With respect to interest rate products, we don't think that the products are going to take on the form of futures. We think they're going to just look like swaps. And we think that with interest rate products, there'll be no broken dates. So you'll be able to trade 1 year, 2 year, 3 year swaps on these exchanges or swap execution facilities. And you won't be able to do off-market structures, so that you'll be able to do a 5-year deal at market, but you can't do a 5-year deal at 5% when the market is 3%. The CDS, there'll be no bespoke transactions, but probably there'll be some cleared products that the exchanges will feel uncomfortable about putting on the exchanges, at least in the near term. With respect to equities and commodities, there won't be any broken dates. You won't have unusual indices, price sources, and so on. The swap execution facilities, as I said, are really an extension of what is already available in the marketplace. The inter-dealer brokers all have very, very sophisticated products that enable them to have the dealers trade electronically. Sometimes they impose voice over that, but these systems can easily get changed so that they can be offered to more parties. Furthermore, if you are clearing, if you're an investment house and you're a client of a clearing member, and you want to do a swap in a 5-year, $50 million swap, you go to your clearing member, J.P. Morgan, and J.P. Morgan then goes into the swap execution facility and executes on your behalf. And the clearinghouse would then take the credit risk, and J.P. Morgan would get a clearing fee, and that's all there would be to it. So it would really change the market dramatically for those entities that are using clearing. In addition to the dealer brokers, companies such as TradeWeb, Bloomberg, we imagine. Bloomberg already trades derivatives on the screen. We would imagine Reuters has every possibility of joining that. And, of course, the exchanges themselves. We imagine that there will be block trade exemptions so that if somebody wants to do a $2 billion rate swap or $300 or $400 million CDS, they won't have to go through exchanges. The big question with this is what will be the effect on the liquidity of the markets. I have a trading background, managed trading desks for years and years. I kind of think that market making has a pretty useful role, and market making will have less of a role in this world. It remains to be seen whether or not the liquidity will be reduced significantly or whether it'll just have a modest impact. I think if it's done properly, it would just have a modest impact on the liquidity of the marketplace. In a more severe scenario, we would see that exemptions for clearing would apply only to official bodies, to governments, supranationals, and so on. We think that this would greatly reduce hedging from end users. End users would all have to have enough liquidity to be able to post collateral, meet the margin calls as and when they occur. The severe scenario would also call for the cleared products to go, all the cleared products to go through the exchanges or the swap execution facilities. And this would, I think, reduce significantly liquidity in most of the derivative contracts. If you wanted to do a 4.5-year off-market swap and everybody knew you were doing it and you had to put that through an exchange, nobody would really care. All they would try and do is make some money out of your transaction. In the event that the U.S. bank derivatives activities get pushed out, it looks like they would go into a subsidiary of the bank holding company. More likely than not, the bank holding company would not be able to guarantee the activities of the swap subsidiary, and therefore they'd have to be separately capitalized. And if you're dealing with J.P. Morgan as a bank, you're comfortable with that. If you deal with J.P. Morgan's derivative products company, you're going to demand quite a lot of capital, and the capital that J.P. Morgan would save in the bank would not equal the amount of capital they'd have to post in the new subsidiary. So across the industry, that would require a significant amount of additional capital. Obviously, this would be beneficial to international banks because the Deutsche Banks of the world could still deal in the Deutsche Bank name. I don't think there's a chance in hell that the Europeans are going to abandon the universal banking setup that they have. In a severe clearing environment, it may not have quite the same impact because everything has to be cleared, and so presumably the foreign banks would have to clear as well. Certainly, if they were operating in the U.S. But there is a scenario where the foreign banks could operate outside the U.S. from London, say, and do their derivative transactions with U.S. names, and provided the Treasury and the SEC and CFTC don't object to the overall regulation of the banking system in that country, they might be able to deal with the U.S. companies the way they have in the past. The unresolved risk issues are interesting. We don't object to reforming derivatives, but if you look at what happened in the crisis, we don't know of any significant financial casualty, by that a casualty to a financial firm, that was caused by anything other than real estate exposure. You can start with AIG, go through then Fannie and Freddie, look at the large commercial banks, Wachovia and Washington Mutual that failed, the large investment banks, you had Lehman and Bear Stearns, their issues were real estate. You have the second biters, I call them. This would be Citi and Bank of America / Merrill. Their problems were caused by real estate in one form or another. Look at the mortgage banks. This would be Countrywide, New Century, American Mortgage. These are all, and all the regional banks that have failed. They have been caused by real estate. Look at the monoline credit insurers. That industry has basically been wiped out because of the real estate issues. Look at the mortgage insurers. They've survived, but barely. In any event, real estate to me, is something that caused the crisis. Clearly, people were taking risk in derivative forms, but the crisis was caused by poor underwriting, poor lending standards, horrific risk management. I don't think any of these entities had a risk manager who said, "Hey, what happens if house prices go back to where they were 3 years ago?" "Oh, sir, we fail if that happens." That's the wrong answer. Anyway, this has not been addressed in the financial reform. With respect to derivatives, most of the losses that occurred in the derivative world were in the form of complex products, the synthetic CDOs that were created, and these are addressed a bit. They have to be, all transactions have to be reported and regulated in some fashion, but there's no way of saying how much risk is there and what are the losses given a default. So that's an issue that remains will remain in the future. So in conclusion, expansion of clearing will reduce systemic risk, but it may create systemic risk itself in the clearinghouses. Exchange trading will increase transparency, but it may reduce liquidity. And what hopefully the regulators will do is create rules that balance these considerations in a way that the costs don't outweigh the benefits. Thank you very much.
Good morning. We there yet? We're not there yet. I've got a fairly narrow topic that I was asked to talk about, which is what to do about too big to fail. But I think it's not narrow. I think it's at the center of the kinds of things that we need to do in reforming the financial system. And as we get closer and closer to the end of the legislative process, it becomes less and less, more and more obvious, I guess, or less and less clear that we've actually done appropriate reforms. I've got a lower left-hand corner here. I've got a half-hearted disclaimer. I have spent the last year at the Federal Reserve Bank of New York. In case you think that my opinions correspond with theirs, you're certainly incorrect. And so I'm speaking only for myself. If you think back to fall of 2008, there were a lot of extraordinary measures taken, and they seemed at the time like a good idea, and I'd argue with hindsight that they were. You could quibble about whether we should have done one thing or another with hindsight. But I think under the circumstances, by and large, the supervisory infrastructure availed itself quite well. But it did leave us with a really huge problem, which had wandered around the margins and was important for a lot of institutions before that. But it's now sort of carved in stone, and everybody knows that there are firms that are absolutely too big to fail. So what I want to do today is I want to focus on what I think is the source of that policy. I'll survey how I think about the suggested fixes, and then I'm going to stick my neck out and make some recommendations, although it's getting late in the day for that. the way I think about it, the main threat that gave rise to the actions in the fall of 2004 was that supervisors and market participants were extraordinarily averse to the uncertainty associated with a bankruptcy procedure. We know that there aren't good bankruptcy procedures for financial firms. You could argue about whether Lehman was better or worse than we expected, but certainly the uncertainties imposed on Lehman counterparties, combined with the fact that they were funding a lot of their obligations short-term, meant that the uncertainties just caused short-term claimants to run. So we have a very bad bankruptcy process. And there's the danger, and this is particularly true, I think, in the, or at least that was the verbiage, in the CDS market. There's the danger that we have all these over-the-counter exposures. We don't know where they are. We don't know whose alleged hedge is no longer a hedge. And so there's just an immense amount of uncertainty. And the government stepped in and said, we can stop this uncertainty by recapitalizing some of the firms involved. And then the unfortunate characteristic for the legacy is that no debt bears credit losses, and therefore for large firms we have at a minimum severely compromised market discipline. So what's the result of too big to fail? It's the thing that we've talked about in the banking literature for 30 years or longer, and that is the same as deposit insurance. I can remember going to a Fed conference every year at Chicago, and guys from the CME would wander over every once in a while and say, you just don't understand how to run organizations. You got to make sure they have enough capital in the transaction day by day by day by day. And if you did it that way, you wouldn't have any problems. And I think that's correct. That's going to be one of my arguments. But given that we have a set of firms that don't pay full price, and maybe not any price, for their debt that reflects the risk that they're taking, then these large firms have a comparative advantage in taking risks. And that has real sector distortions. Look at the housing bubble. We have lots of houses we don't need. And it also has competitive implications, because just below those too big to fail firms are some firms that don't have the same stamp of approval. And so there are competitive inequities that come about as a consequence. Now, fixing that is really pretty simple in concept. You've either got to devise a mechanism where the firms don't fail, or you've got to define a mechanism where the turmoil associated with failure is acceptable. And I think it comes down to that. And so when I look at solutions to the too big to fail problem, I think of there being sort of a negative externality, that these guys are taking risks that are born somewhere else to some extent. And so if you look at this graph, the horizontal axis is the firm's risk. The vertical axis is the firm's cost for bearing risk or accepting risk. And you can imagine that there's some sort of socially preferred level of risk. I don't know how to make that come true, but you can imagine that. And you can enforce that socially preferred level of risk either by pricing risk, either with an insurance premium, a liability tax, a capital standard, or by simply imposing a quantity restriction. And you might think of the Volcker restrictions, or moving the CDS trading outside of the banks or into a separately incorporated subsidiary as a quantity restriction. Now, economists like price or fee-based ways to ration scarce goods. And if we actually knew where this downward sloping line was, we could use equally well either a fee or a price, or we could use a quantity. The problem is, suppose you're a supervisor and you're not really sure if the supply of firm risk is the blue line or the red dotted line. Then if you set a fee, you're going to have bounded the amount of excess risk, but you're going to have a lot of uncertainty about where the excess risk will actually wind up, how much of it there will be. So then you say, okay, well, that argues for quantity restrictions, but suppose you can't measure. Suppose the downward sloping line is known, but we have a lot of trouble measuring the firm's risk exposure, either because it's hard at any point in time or because supervisory information lags, and so you're never quite sure where the risk is. So both of these problems, I think, are real for the supervisors, and one of the characteristics of the problem is that the set of activities that a firm undertakes affects either the uncertainty either in the left-hand graph there or in the right-hand graph. So when Paul Volcker first started talking about activity restrictions, I thought that he'd finally gone over the hill, and that didn't make any sense at all. But the more I thought about it, the more I thought that in the context of uncertainty about what the supervisors can see and how well they can measure it, that quantity restrictions, Volcker restrictions, might make some sense. So I think when we talk about too big to fail solutions, we ought to recognize a couple of principles. One is the supervisors have a big information problem. And that gives rise to the notion that maybe a supervised firm shouldn't be doing things that the supervisors can't keep up with. Now, that's a very, sort of deep, we can talk for a long time about that, but I think that that's a pretty important consideration. Second, we've got to ask, as a couple of the speakers mentioned, we've got to ask, well, if we squeeze the risk out of the financial sector that we regulate, where's it going to go? Is it going to go to hedge funds? Is it going to go to civs? Is it going to go to Thailand? And I think we know very little about that, except my strong intuition is that raising capital standards and imposing strong regulations in this country is going to shift risk out of the regulated financial system. So we could have an extraordinarily secure banking system, but a very insecure financial system as a consequence. And I think that's a really important danger. I don't have a very good feeling about how to kind of quantify the trade-offs, but I do have a suggested way to minimize some of the effects, which I'll get to at the end. So I sat down to try to think about all the different ways that people had suggested responding to too big to fail. And they fell into two categories, and I can split them two ways. Some of these things affect the price of taking risk, and some of them affect the quantity of risk you're allowed to take. And similarly, some of the recommendations affect the PD, the probability of a firm's default, and some of them affect the loss given default. So, for example, expedited resolution is supposed to affect the loss given default. A bad thing happens, we have a new and better way, quote unquote, to resolve the uncertainty, and that therefore is a better thing. So thinking about price and quantity, thinking about PDs and LGDs, that's how I conceptualize the possible responses. Now, in the interest of time, I'm going to skip about most of what I talk about, sort of throwing some things out and keeping some things in, and say what I think is important for addressing the too big to fail problem. I think a CCP is absolutely vital. If we beamed somebody down from Mars and said, hey, look at the way we settle trillions and trillions of dollars worth of derivatives contracts, that person from Mars would say, you're nuts. That doesn't make any sense. It ought to be centralized. There are scale economies in evaluation. Now, I know that it's not as clear as that, that there are offsetting costs associated with central clearing. But it seems to me that that's a really important thing for the stability of the too big to fail part of the financial system. I'd also limit some volatile investments. It seems to me in particular that there's an abundant amount of private capital anxious to do proprietary trading and private equity. And getting those things out of the banks, and of course there are only a few banks where those activities matter, but getting those things out of the banks is going to make the supervisor's job a lot easier, and I don't actually see much of a social cost from that reallocation. Now, despite what David Martin said about higher capital requirements, I think the problem with capital requirements has been not that they weren't high enough, but that they're not enforced. That there's a distinction between book capital, which is what the regulations are written on, and market values of capital, current assessments of what the firm is really worth, which the regulations have nothing to say about. And I'll show you some examples about that. So I'm actually in favor of higher capital. I talked about the CCP. The systemic nature is extremely important. I recognize that in principle. I'm sure I don't recognize the details. But I do remember what Mark Twain said, which is you put all your eggs in one basket and watch the basket very carefully. Now, by the same token, it appears that if we get competition for central clearing parties, I think if there's a lot of competition, I think there's a real danger in that. Because one of the dimensions of the competition is naturally going to be reducing margins. So we're kind of stuck between the fact that I like competition a lot, on the other hand, I really worry about, and we know there's big scale economies in clearing and unwinding positions. So I think there are a lot of thought needs to go into that. And I recognize that Mark Twain has something to say about this, as he does, I guess, about most things. The VOCA restrictions, I basically said what I think about that. I think that they're going to affect a couple of firms. There's, of course, a very fuzzy line between proprietary trading and market making. I don't know how to address that qualitatively, though. I think that we should sort of shift the property rights and move to a presumption where there is less rather than more proprietary trading in regulated entities. Higher capital. Okay. Higher capital forces firms to internalize risks to a greater extent. Higher capital is protection for the taxpayer against whatever risk it is that happens to cause the problem. So higher capital has a lot to say in terms of making too big to fail firms, keeping them from exposing the taxpayers to big losses, and reducing the probability of failure of those large firms. Now, at the same time, higher capital standards are going to drive business somewhere else, and we don't know if we can see it there. So I've got to make that caveat, and I'll come back to that. But first I want to make a point about compliance. Here's a graph that one of my colleagues at the New York Fed put together that has 3 lines. The red line in the center goes back to the first quarter of 2004, and it is the average book capital ratio for the 18 firms that were subject to the stress test last spring. That's the red line. It's very smooth. You'd never know that there was a problem. The blue line is the ratio of the market value of those firms' equity to their on-book assets. We could argue about what the right deflator is. But the important point is that starting in early 2007, the equity market value started to tell us that something was going wrong. And there were times after the first or second quarter, after the second quarter of 2008, that the equity market value was substantially below the book value. The green line just tells us the same thing as the blue line. The green line is the CDS spread, and that axis is on the right-hand side. That's the average CDS spread for those same 18 publicly traded financial institutions. Now, lest you think that's an aberration, of course, here's a local company, small local firm. The blue dotted line is their Tier 1 capital risk-weighted assets. I love this line. I particularly like this part of it. After the second quarter of 2008, we know that Citi sold a lot of Tier 1 capital, most of it in the form of perpetual preferred, which had very special idiosyncratic or firm-specific character. But while the firm was increasing its regulatory capital, the market was saying, essentially, we think your losses are larger than that. And so the market value fell. Lest you think I'm picking on Citigroup, same thing happened to Bank of America. And my point is that if you're a supervisor and you are bound or inclined, or whatever the right word is, to regulate according to the blue dotted line, then you can't possibly be keeping track of capital. So we have a sort of set it and forget it capital level, and we have no mechanism whatsoever built into the regulatory process to replace capital that gets lost, that gets eaten up. Now, is the market always right? Of course not. So we're going to have to decide whose mistakes we like better, whose misvaluations we like better. But I would certainly like to see some more market information included in the supervisory process. Now, what's wrong with raising capital? There's the headline wrong, disingenuous argument that the weighted average cost of capital is going to go up immensely for regulated firms, and nobody will be able to get a credit card loan, and businesses won't be able to form. Again, a much deeper issue. The estimates I've seen and the calculations I've done suggest that that's not a very big effect, but that's certainly a politically important effect. I think the really big danger is the third one here. We're going to drive risk into the shadows if we raise capital requirements. So what I'd like to do is let banks hold some of this capital in the form of contingent capital bonds. These, in case you've never heard of them, these are things that are issued with the stipulation that when the market capital ratio gets below a certain level, the debt converts into equity. In other words, when the firm's capital in real terms has, in the opinion of outside investors, fallen low, then we recapitalize or we delever. The nice thing about it would be if it were tax deductible. There appears to be some question about how the IRS would treat it. I don't know of anybody who's gotten a ruling on that, but the tax deductibility would be very valuable, because I think what we could do is we could go to the banking sector, the regulated sector, and say, look, we want you to hold higher capital, but we're going to let you hold some of it in the form of contingent capital. But this is not the bargain I want, where the total amount of downside protection is the same from both arrangements. I want a bargain where you can hold 8% common, just making a number up, you can hold 8% common, or you can hold 11%, of which 5% can be contingent, and therefore tax deductible, and therefore doesn't hurt your ROE on the upside, but it does protect losses and absorb losses and protect the taxpayers on the downside. So those are numbers different from what I just said. The point is, I think that we can get a higher downside amount of protection into the banking firms by providing a tax-deductible venue. And if we make the conversion or the delevering contingent on market as opposed to book accounting numbers, then we're going to be deleveraging firms at the time when they need it. Now, one last thing about contingent capital. Many of you might be thinking of October 2008, when the world had fallen apart and short sales were forbidden, and everybody was afraid that the market was misvaluing firms and misunderstood them. That's not when I want the contingent capital to convert. I want the contingent capital to convert in June or March of 2008 and prevent us from getting there. So if the tranche of contingent capital is thick enough, and if you kind of do a mental calculation, suppose the tranche had been 5% of assets and the tranches had converted in the spring of 2008, we wouldn't have gotten nearly as deep, I don't think, into trouble as we actually did. But the point about the contingent capital is that it's a response to the concern that high capital ratios are going to drive things overseas or into the shadows. So those are my three recommendations, and then I end with a caveat or a proviso that says that nothing that I've said, or nothing, if I had more time, that I would say, is going to protect us from the possibility that we're going to have large firm failures. We're still going to require a lot of active supervision, and we're still going to require a mechanism whereby we get firms to worry a lot about their counterparties' risks. Thank you very much.
We'll do 5 minutes of questions for the panel.
I think the Washington view of the crisis is that there was too much risk, not enough capital, and not enough regulation to control risk. I think there's another view, I'll call it the financial lawyer's view, because I'm a financial lawyer, that the fundamental problems were liquidity and credit, and that all the things which I've sort of heard about what we're doing today really don't do much to improve liquidity, and certainly aren't improving the mechanisms for the flow of credit. The Fed is even going to be more constricted than it already is in terms of the pipeline that's available, and I don't hear of any other institutions being created to create liquidity. I mean, do you think that these are the real problems that we have to deal with to prevent another crisis, and that we aren't doing enough about them?
I'll start. I don't know if this is on. I'll try to speak up. First thing, I think that anybody who I've ever heard say we need more regulation to prevent another crisis has struck me as saying the wrong thing. Okay, the regulations were in place. All sorts of things could have happened. Supervisors didn't act. Did they not act because they're bad people? No, they didn't act because there was a genuine difference of opinion about what real estate assets were worth. So I think that regulation is the wrong. Extra regulation is certainly not an appropriate response. Second, in terms of liquidity, it seems to me that if firms are all agreed to be well capitalized, liquidity problems largely take care of themselves. So I don't view the crisis, at least from where I'm sitting, I don't view it as primarily a liquidity crisis, but rather a crisis of confidence about solvency, which gave rise or was manifested as people being unwilling to lend to one another.
I'll make a comment. I think
having more capital, of course, can't hurt. But I honestly think the biggest issue was risk management, that people did not look at what the downside was to the positions they were taking. And the fact that, one position alone that I saw at our reinsurance company was $11 billion slice of CMBS that was all triple B. And if you really figured out the underlying, it was $2 trillion. And your risk was loss given default, you lose it all. But you got 10 basis points. And that one trade would have wiped out the monoline that did that trade. And people just were not disciplined enough to manage their portfolios of risk properly, to give that enough credence. And the regulator should insist on having risk management that is a very, very strong, has a strong source of authority in each firm. If you don't get that, I mean, people are going to it's a herd mentality, and they're going to do something very, very silly again. Again, more capital helps, but if you had more capital, you would not have escaped 2008 and 2009.
I mean, I think from my perspective, you'd have to say to yourself, when does a problem exist? And I would say a problem always exists, but it becomes a problem when you recognize that it's there. So that's one point. Second point I would say is, and I agree with the first panel, that problems just don't come out of the air. There are a multitude of things that fail. So you have to, and if you want to fix them, you have to think about, well, what failed and how do you fix that? And at that point, I just raised one interesting thought. I like risk managers that blow themselves up because they get humility. And one of the things I did was hire a senior risk person, person for one of the major rating agencies that was in charge of securitization. And in the interview, I said to him, well, how'd you blow this? Like, how did you guys just blow this? And he said to me, we never thought real estate would go down. It was that simple. And I think that when you think about major problems, I'll just give you one other anecdotal piece. I had lunch with Margaret Thatcher many years ago in Singapore. And I said, how did you go to war, with Saddam Hussein the first time around? And she said to me, don't let a bully push you around. So I just called up Ronnie and we went to war. It was very simple in terms of the thought process and coming down to like principles of how you think about things. And if you think about this crisis, there's just a couple of things, major themes that roll out of it that you got to fix. Like, I'll give you one: the American dream. Everybody has a house. Well, when my cleaning lady and her husband's a baggage handler at JFK, and lovely people, when they bought a $500,000 house, I said to myself, "Whoa, something is not right here." So I just think you got to go back to very simple things and fix those things. And it comes down to what is important. If you think the stability of the deposit system is important, then maybe Glass-Steagall is the way to go on that score. But I don't have the answer. All I can tell you is that it's not one simple thing, A and B. It's a multiple of things that come back to very simple principles in terms of what you really want to do.
Yes, sir.
Well, I think there is one simple thing, and you used the word principles. Isn't the problem sort of a lack of ethics and principles? For example, if the mortgage industry was really about getting mortgages in the hands of everybody who deserves to have a mortgage, that makes sense to have a mortgage, that industry would know their job was done, mission accomplished sometime, I don't know, 8-9 years ago. And we don't, so that isn't part of the regulation. Self-regulation. How can we say that risk management wasn't strong enough when the heads of the firms squashed them? Often, many of the risk managers I know were screaming bloody murder, though they didn't have the principles to quit, go to regulators, and go to the press. But the problem is one of lack of ethics and principles, and isn't that the fundamental, simple principle?
I don't disagree with that. I think if you have a large organization, you have to have checks and balances, and it's up to management to put those into place and make sure that the checks indeed have authority. you're not going to. Why do you have any laws or any rules at all? It's to avoid miscreants that are going to cause problems.
Yeah, the answer is the reason you have rules is so that the participants aren't at the whim of the bad guys in their industry. And yet our industry spent most of its time trying to figure out how to get around rules, find the loophole.
But why don't you have rules of saying that the banking system has to have a 75% loan to value on its mortgage portfolio? Wouldn't that sort of thing have stopped 90% of the?
I absolutely agree.
But I mean,
but the industry needs to support that, not try to figure out how to.
Well, the industry and indeed the whole economic system, because the banking system was not the only person originating mortgages.
Precisely.
So are you going to say that you want everybody in the world to be good? That's. I don't disagree with it, but.
Yes, I want that.
You want that, but
wouldn't I want
that's not reality, though. But you can't assume that that's going to be what happens.
Absolutely.
Especially when you could literally finance 100% of your exposure in the securitization market.
I don't think we're going to solve this question.
We're on the same side.
Let's take another one.
Yeah.
Yes.
Yes, this is mostly directed toward Mr. Volstead. Given the events of AIG where you had issues with flows from subs to the parent company, do you see any issues with regulators like New York State regulator, for instance, with the insurance companies not allowing insurance entities to participate in the clearing venue where you would have the very important concepts that you brought up of segregation and portability of collateral?
I didn't catch all of that question. My understanding is that insurance companies are going to have to clear their transactions through a clearinghouse, provided the clearinghouses can handle the transactions. I'd say, though, that clearinghouses are not going to be able to clear synthetic CDOs, which is what AIG had. And I think that clearing as much of the stuff that you can with major swap participants makes an awful lot of sense.
Just as a brief follow-up, there is some concern in the industry that any collateral that would be pledged could be rescinded by the interest of the New York State regulators, that's all.
Okay, that's a technical point, but generally the clearinghouses are going to preserve the collateral in the name of the client.
One last question.
One
last one?
Sure, go ahead.
Go ahead, Miles.
To follow through a little bit more on the mortgage-backed dilemma here, haven't we forgotten the elements to this structure that there were LTVs in place that weren't like 125 until the politicians forced a change in the underwriting standards, who then were outraged when the thing unraveled?
I don't understand.
It's a political question, so we dodged it.
I think we'll, with that, take a break. Sorry. No political. Sorry, quick housekeeping note. We're gonna take a shorter break. We're gonna start promptly at 11:35 with Andy Lowe. So go get some coffee, take a refreshing break, come back 11:35. We'll start up. Thank you.
It was okay. I understand. I was wondering. I'll email. I'll look at that and then I'll email.
A whole variety of different responses. Yeah, the concept is actually airing on downside risk. One day we're going to find out. One of the things that really worries me about raising companies, I don't know, is obviously have a great deal of smart. Right. I don't know to what extent it's Oh, I remember that. Yeah. You did. You did. I always remember reporters of your life. You're very welcome. Absolutely. Great. Well, I'm position as an investment scholar. I got involved because of the I got involved with some staff. That's the only secret stuff. I was supposed to go around. I got involved working instead. It was a wonderful deal, actually. I have a lot of time. The Europeans say their idea of contingent capital is subordinated debt. Bear losses, and Canadians are pushing a form of debt that at the discretion of the supervisor can be converted. Anything that involves the supervisor is going to be very hard to trace. That's right. The UK is one like us. Shellco's were issued by Lloyd's Bank. First of all, it's important. They'll exchange bonds that were selling in 76. All the firms changed. Well, yeah. So, because it's book. Yeah, exactly. So we know that yes, and it was structured